I'm calling the meeting to order and starting off, I've already mentioned Valerie Smith is new she's with Assistant Director of Engineering in the Water Resources Department, and she will be our new employee participant for the coming fiscal year. She has been with the plan for over 21 years, so this is a good way for her to learn a little bit more about what will take care of her in the future when she decides to retire from the city. Also, Kurt Wade is our new city council representative. He's replacing Ronnie Martin. He's been with council, let's see, are you
4 years.
You're currently for your first time to be reelected, right? Yeah. So he's been with us a long time, it feels like, in some ways, and I sit by him at council meetings, so he's been a good partner to have. Everybody else's terms that were extended till June 1st, 2023, we appreciate y'all being willing to continue your service. Our first item to consider for a vote is our consideration of our minutes from the February 19th, 2020. If there's any motions for approval or any comments for corrections, please let us know.
I'll move to approve as submitted.
Second.
Thank you. All in favor, vote aye.
Aye.
Aye. Any opposed? Okay. Number 4, actually, on the agenda is Nataka Bukalo of Chartwell Consulting, and she's going to kick us off with the first quarter 2020 plan performance asset allocation, the May 2020 flash report, and rebalancing recommendations for the defined benefit pension plan. Nataka, it's all yours.
Thanks a lot. Good morning, everyone. And here up at Chartwell, I also have Michael Hislop, one of our analysts that works on the Murfreesboro account, joining me to listen in. I know, Melissa, you've probably seen his name on some of the rebalancing worksheets. So
I have.
Yes. So, so there's quite a few things I'd like to cover on the agenda in addition to some of the items that Melissa mentioned. I also would like to introduce and review a U.S. REIT, so U.S. Real Estate Investment Trust Fund option, which we think would be a good thing for the city to diversify into. And we'll get into that after we cover the first quarter performance, and then also I'll be providing in April and May, and to the extent possible, a few comments on June. It seems like every time I put together comments on the market performance, give the market a week, and things change pretty dramatically. So it's a moving target. It's difficult to keep up with, but we do our best, and we'll try to give you the most up-to-date information we have. If you'd like to follow along with some of my comments, if you go to your green books into the executive summary section, as I briefly review the first quarter performance, you'll find the comments on pages 2 through 6 of that report. And fortunately, I'm not going to read it at you or review everything, but no doubt the first quarter of 2020 was an unprecedented one, and it does deserve some commentary, to say the least. So the first quarter was the worst quarter of performance the markets have seen since the great financial crisis of 2008 and 9. Some of the highlights or lowlights is that the VIX, the volatility index, reached an all-time high of 82 on March 16th. Just to give you some perspective, in 2018 and 2019 in particular, there were many times where the VIX was in the low teens. Not sure if it ever broke into single digits. It might have for a little while, but it was normally hovering around 14 to 18 points in 2019. So to see it spike to 82 on March 16th certainly gave everyone underscored the volatility that the market was going through. The daily average stock price move during the month of March and going into early April was plus or minus 5%, and most of those, unfortunately, were minuses in March, and an 11-year bull market very swiftly came to an end. The S&P experienced its swiftest fall from peak to trough ever, falling 35% in 22 days. So there wasn't really a lot of time to think or react. It just pretty much happened. The free fall of the markets slowed at the end of March and beginning of April as governments and central banks around the world unleashed unprecedented fiscal programs and monetary policies to shore up the various economies and to keep the markets liquid and open. But to recap some of the weak results from the first quarter, U.S. equities, large cap, were down 19.6% for the first quarter. Mid caps were down 27%, and small cap stocks were down 30.6%. International equities also fell, and both developed and emerging markets actually fell similarly, minus 23% in each case. Ironically, within emerging markets, China, where the coronavirus sort of started and was the first epicenter, was actually the best performing emerging market in the first quarter, dropping only 10%, as by the end of March, they were showing signs of reopening the economy. Bond markets also had a very challenging first quarter of performance and posted very mixed results. Interest rates fell from 1 point on the 10-year bond from 1.51% at year end to 0.7% on March 31st. So an 81 basis point slide. And so that significantly benefited long-term bonds when interest rates pull back that way. Also, credit spreads ballooned in the high-yield market to over 1,100 basis points, and in investment-grade corporate bond markets in the 300 to 400 basis point range. So once again, unprecedented levels. Government bonds were the beneficiaries of the fear trade and the flight to safety. Government bonds were up 8.2% in the first quarter. Agency mortgage-backed bonds were up 2.8%. Everything else was negative in the fixed income market. Investment-grade credit bonds were down 3.1%, and high-yield bonds plummeted 13.1%. Real assets did not escape the market's wrath and the market's downfall. Oil prices dropped dramatically in the first quarter, and natural resources plummeted 42%. In the first week of April, oil futures actually dipped into negative territory for a few days. That's sort of how bad it got. There's been quite a significant rebound as oil is back up to about $37 or $38 a barrel, but we'll talk about that in a few minutes. And also, REITs, both global and domestic, were down in the 27 to 29% range. So it was a very, bleak first quarter of performance. There were very few places to hide. Government bonds and agency bonds and cash being really and gold being the only positive performing asset classes globally. If you turn to page 7 of your executive summaries, that's where we'll review the asset allocation and some of the performance of the plan for the first quarter. So the city's asset allocation was not well positioned for a global bear market across all asset classes. You have a very diversified portfolio. It's heavily weighted in equities because we're trying to maximize the consistency of achieving your long-term actuarial interest rate assumption. You do have exposure to diversified fixed income, a lot of credit bond exposure, primarily through Pinnacle, so that was difficult, and you also have high yield exposure, and you have exposure to both natural resources and REITs. And from my commentary, you know that a lot of those areas were very challenged. The city's total fund composite for the first quarter dropped 18%. Very difficult quarter. It lagged its target policy by 1.5%. So a blend of the target indices was down 16.5%. Your assets dropped from $151.8 million at year end to $124.3 million at the end of the first quarter. On pages 16 and 18 of your executive summary and performance reports, you'll see the performance of all of your composites as well as the individual managers. One of the things that, if you leaf through those pages that you'll notice is that only one manager in your lineup posted a positive return in the first quarter, and that was TCW Total Return Bond Fund. It is one of your largest holdings. They have about $18 or $19 million of the plan assets. You might recall that TCW Total Return emphasizes investing in mortgage-backed bonds. They can invest in agencies, non-agencies, asset-backed. They can invest in government bonds and in cash. They are a very good complement to the Pinnacle fixed income account, which is predominantly credit bonds, investment-grade credit bonds, and a little bit of mortgage securities. Fortunately for TCW, they entered the first quarter with a very high quality and defensive portfolio. They were about 75% invested in agency mortgage-backed securities, another 18 to 20% invested in government bonds, and about 9% in cash. They remain, through May 31st, the plan's top performing manager. Through May 31st, they're up between 6 and 7%. Again, I'll get to that when we do the May update. So they were very well positioned going into this. Some of your managers that were more challenged, if you look at page 12 of your executive summary, we show sort of the key contributors and detractors for the quarter. And we show that in both absolute and relative terms to the index. So you did have a number of managers that outperformed their indices. They still posted negative returns because the indices were negative, but they dropped less than the indices. But TCW stands out as the only positive absolute return. And some of the more challenged managers were your mid-cap value manager, your high-yield bond manager, the natural resource manager, fell in line with the index, and you are in an index ETF. So that's sort of a review between page 12 and 16 and 18 of a lot of the individual managers and how they either contributed or detracted from performance. So that's my commentary on the first quarter, which is rather bleak. I was going to give a bit of a performance update through May 31st, and the picture gets much rosier. But if anybody has any questions on the first quarter that you'd like to ask now, let this be as interactive a meeting as you like.
I'm glad it's over.
Oh, you and me both, let me tell you. Okay, so just to give you some updates on April and May, and you have in front of you the May monthly flash report, and we also put out monthly market commentary for May. What you probably don't have in front of you is the April flash report, which, I'll summarize sort of the performance commentary from there. But both April and May, the markets rallied strongly, and that is, across the board, equities, bonds, as well as real assets. And just as the plan was positioned poorly for the first quarter, the plan was positioned well to participate strongly in the April and May relief rallies. Assets of the plan finished May at $137.7 million. You recouped $14.1 million of your $27 million unrealized losses in the first quarter. So that's about half of the unrealized losses were regained. We also provided you with performance updates, a separate handout of all of your managers updated through May. So those tables will have all of the individual managers. It will have the May monthly return, the year-to-date return through May, and then trailing period returns. Our performance accounting software does not allow us to run partial quarter or partial year-to-date composite returns. So we were unable to run on that software an estimated, if you will, return through May 31st year-to-date. But Michael put together an estimate calculating some returns based on the market values at the beginning and end by each asset manager and the percentage they were allocated to the fund. And we estimate that the plan's year-to-date return through May is minus 9%. So again, about a 50% improvement over being down 18% at the end of the first quarter. So between the assets and the estimated return, we feel pretty confident that the plan sort of, if you will, clawed back half of the unrealized losses. So it was a good thing that both in April and in May that the rebalancing recommendations were very minimal and that you pretty much, sort of stayed put, and many of the areas that were hit hardest, so for instance, high yield bonds, rallied back very strongly. And your credit bond exposure, Pinnacle fixed income, which had a negative return at the end of the first quarter, is back in positive territory. So at the end of May, on a year-to-date basis, the plan has 3 managers that are in positive territory, and that is TCW Total Return, Pinnacle Fixed Income, and PIMCO Global Hedged Bonds. And many of your equity managers, if you go to the second page of that performance handout, you'll see that the year-to-date returns, you have many that are in the sort of single digits. I mean, Vanguard small cap growth is now down only 2.2% year-to-date. Janus Enterprise down 6.6. Pinnacle large cap equity down 4.4. Significantly better results, and the growth stock areas have been the areas that have rebounded the most strongly in April and May. And within fixed income, it's really been a strong rebound in credit markets. Some of the fiscal programs and monetary programs that were introduced by the Fed backstopped investment-grade credit bonds, high-yield bonds in the form of fallen angels, and high-yield ETFs. And when Jay Powell made his speech, I believe it was on March 23rd, that these programs were going into, that the Fed was going to be backstopping those areas of the market, credit bonds immediately began a recovery period. So, some of the strongest performing segments of the market. We still believe at Chartwell that we're experiencing relief rallies. In some ways, it's very difficult to understand the rapid rebound in the marketplaces when you still have historic unemployment levels, when the economy is still mostly shuttered, where GDP is minus 5.8% in the first quarter and is anticipated to be perhaps double-digit minuses for the second quarter. It's a little bit of a head-scratcher as to why the markets have rebounded so strongly and whether it's sustainable. And, I guess I forgot to mention a little thing about, a vaccine or even treatments for the virus that would give us confidence that we can, reopen our economy and perhaps, not have to face another wave or shutdown. So, but, we'll take it. The plan was positioned for it. The other thing is the plan is in a very good cash position. All of last year, we were trimming equities and other overweight asset classes on strength and building operational cash to about a double overweight position. Certainly did not anticipate a global pandemic taking the market down the way it did, but it was really nice to know that the plan had 12 months of cash on hand to pay benefits and did not have to liquidate into a very volatile market that was moving plus or 5% on a daily basis. So those are my performance updates. I was going to move on to rebalancing unless there are any questions.
I don't see any.
Okay.
Speechless.
Yeah.
I don't know how many times I can use the word unprecedented, plummeting, but we're still in extraordinary times. So, okay, so rebalancing recommendations for April were minimal. As I said, we didn't change too many things around in April or May. And what the rebalancing recommendations in April focused on making some movements between your dedicated international equity manager and your global equity managers, and also a small reduction in global bonds, which are being sort of phased out of the plan's allocation in favor of U.S. bonds. And then the May recommendations were also very minimal, and they focused on selling a little bit again of global bonds and putting it into operational cash, and also moving money around between your mid-cap growth and mid-cap value manager to increasingly favor the mid-cap growth manager, Janus Enterprise. And then most recently with your May monthly flash, so the rebalancing recommendations for the month of June, there were not any that we identified for May because things were close to target, a little bit overweight in equities because of the strong comeback in April and May. And also we were anticipating going over the U.S. REIT fund search, and figured if you decided to add a U.S. REIT fund to the portfolio, that's a good time to conduct near-term rebalancing. So if there aren't any questions on either the asset allocation or the rebalancing recommendation since the first quarter, I can move on to the REIT search.
I think we're ready for that. Thank you.
Okay. All right. I always say that good news is quick to deliver. It took me a little bit longer to deliver the bad news, so sorry to put you through that pain. But very happy that the plan really participated so strongly in the recoveries in April and May. There's still a ways to go before we're out of the woods. And, June started off in a very volatile fashion as well. Sort of the first few days of June were very strong. Last week we saw a significant pullback. It was, all of a sudden people began worrying about, the virus again as the economy is reopening. And all of a sudden people were also looking at the amount of, debt on the Fed's balance sheet and sort of saying, wow, how are we long-term going to work our way out of this? But it seems like a lot of those concerns have gone away again this week. The market's been in a rally mode the first 2 days of this week. We'll see what happens. Okay, so the REIT fund search, you have a separate handout for that. And really, on the first paragraph on the first page, we just sort of review, why we conducted this search and why we're making this recommendation. And as you recall, about 18 months to 2 years ago, the plan went through an asset liability study, and a new strategic allocation was developed to better position the plan to more consistently achieve its long-term actuarial interest rate assumption. And in that update, there was an expansion of the plan's allocation to real estate, moving it from 7% to 17%. And that allocation was, the committee decided could include either private or direct real estate partnerships or public real estates in the funds, in the form of a REIT fund. Going into this, the plan's existing exposure to real estate is through a global real estate fund, the Prudential Global REIT Fund. And with the increase in diversification, with the increase in the allocation, we think it's prudent to diversify the plan's exposure into real estate. And we've looked at a lot of private and direct real estate partnerships, and we were going to propose some, and as the first quarter unfolded, a couple of things came out with real estate, and that is, real estate also got hard hit in the pullback. There's a go-forward concern about potentially rental payments and certain sectors of the real estate market, such as retail, senior living, potentially being, very hard hit in addition to hotels and leisure properties. And when you look at private or direct real estate partnerships, they tend to invest in a lot of what I'll call the core sectors of the real estate market. So that would be retail, it would be offices, it would be industrial, and it would be residential. And they don't tend to invest as much in non-core sectors. And non-core sectors would be things like storage, warehouse, as well as self-storage, life science facilities, so labs and other research facilities, data centers, cell towers, timber. All of those things are other property types. They are more predominantly represented in public real estate portfolios through REITs. So I think that the initial diversification for Murfreesboro at this point in time would be a public real estate investment focused on the U.S., and one that took advantage of some of the non-core sectors which may perform better in the next few years as the markets recover and take advantage of the areas of real estate that might benefit from Amazon sales and warehouses and cell towers and more research being done and warehouse and storage facilities. So that's why we conducted the real estate search and are presenting some candidates for your consideration. So any questions on sort of, why we're looking at public real estate versus direct real estate at this point in time?
That makes sense.
I think we're in agreement.
Okay, so then on page 2 and 3 of the report, we just sort of review the criteria that we used for conducting the search, what we were looking for in a REIT fund, and then we've identified on page 3 4 finalists, sort of for your consideration, and they are Cohen and Steers Realty Shares, Principal Real Estate Securities, DFA Real Estate Securities, and the Vanguard Real Estate Index Fund. And probably the best page for the committee to focus in on as we go through the discussion would be page 4. And there we have 3 tables that provide a lot of quantitative return information in the top table, and a lot of risk and sector allocation information in the second table, And then qualitative information about the fund, size, number of holdings, the fees, can all be found on the third table. All of the results on this table, as is highlighted at the top, are through May 31st of 2020. You'll see in each of those tables that there are 2 indexes that are referenced in this search, and I think that what is sort of most interesting is that they're both REIT indexes, obviously, and but they significantly differ. So even though they're representing, if you will, the same asset class, returns can be quite different, particularly when you look at the year-to-date period. You'll see the MSCI US REIT Fund through May 31st is down 21.2%, whereas the FTSE North American Real Estate All REITs Index is down only 15.3. It's a pretty significant difference, 7% in the same asset class. If you drop down to the middle table and you go over to the right-hand columns where we show the sector allocation, it's explained, the difference in return is pretty well explained by 2 points. If you look at the column labeled retail, which is one of the hardest hit sectors, you'll see that the MSCI US REIT Fund has 18% exposure, whereas the FTSE has only 9% exposure. And if you go over to the second to last column from the right, infrastructure and cell tower, the MSCI US REIT Fund has no exposure, and the FTSE has 20% exposure there. And that's been a top performing sector in the REIT marketplace, not just for the first quarter, but for the past year to 18 months. So those 2 sector differences really account for the majority of that 7% difference. So we felt it was important to show you both, and if you read through the thumbnail write-ups on each of the individual funds on pages 5 through 7, you'll see that some of these funds are benchmarked. They benchmark themselves to the MSCI, the MSCI REIT Index, and some to the FTSE. Interestingly, the Vanguard Real Estate Index Fund used to be benchmarked to the MSCI US REIT Fund, but recently, in the last year or so, they have changed from that index to an index called the MSCI US Investable Market REIT Index. And the main reason for that change was the inclusion of cell towers and data centers and some of those non-core sectors. So Vanguard, even as an index fund provider in the U.S. REIT space, very carefully chooses what index it wants to benchmark against, and has clearly recognized the impact and perhaps the growing and future importance of some of those non-core sectors. Of the finalists, of the 4 finalists, Cohen & Steers and Principal Real Estate are the most fundamental and active managers being presented. GSA, as it is with all of its investment funds, is a very quantitative and systematic investor. They are not bound or tied to, they're not an index fund, but they do invest in a very model, quantitatively based process. So, if you drop down to the bottom table, let's see, do we have total holdings? I don't see total holdings in there. Oh yeah, no, there are total holdings. The middle column, you'll see that both DFA and Vanguard have the most holdings because of their either index or very quantitative and systematic approach. They also, DFA and Vanguard, sport the lowest expense ratios because of that. DFA is 18 basis points and Vanguard is 10 basis points as an index fund. All of these funds have long track records. Cohen and Steers, they're primarily in the real estate investment management business only. They're a very specialized and dedicated shop. They've been doing this sort of longer than anyone in a REIT fund structure. So, very strong in the field. You can see on the middle table the various, how the various sector allocations amongst these finalists differ. So, for instance, principal real estate only has 2.8% invested in infrastructure and cell tower, the least of the four finalists, and yet they're the second best performing. And in over long periods of time, they're the top performers. So they're clearly doing something right amongst security selection in other areas. All of these funds are very underweight the retail sector when compared to the MSCI US REIT, and all of them are pretty much on top of the retail sector exposure. In talking with them about their retail exposure, many of them will say they're not invested in shopping malls in REITs, shopping malls. They are more invested in things like grocery stores, or like mall areas that are anchored by a grocery store. So there are, even within retail, there are like nuances of retail. They're invested in what I'll call the big box shops, whether that's a Costco, whether that's a Walmart, whether that's a Target. So those tend to do a little bit better than large indoor shopping malls at this point in time. I'm going to sort of stop here and pause and see if I can address any specific questions or help you differentiate between these four finalists.
Hey, Natalka, it's Greg.
Hey, Greg.
So I'm looking at the 10-year total returns on each of these four, and they're not, all that different, anywhere from 8.9 to 9.8 from top to bottom. But like you pointed out, the expense ratios are wildly different between the top two and the bottom two. Should we be concerned about these expense ratios, given that their performance is pretty much right there together over the long term?
Well, what I would say is that active managers are always more expensive than quantitative and index fund managers. By having a higher expense ratio, they are creating a higher hurdle for themselves to get over, because all of the performance numbers that you're looking at here are net of fees. So, for instance, when Cohen and Steers or Principal wake up in the morning, they know that they have to do close to 1% better to get to the same point on a net basis. So I think that fees are always important. Within the active manager community, being under 1% for a REIT fund is good. That makes them, with an active, low cost. But I guess I wouldn't be overly concerned, but, particularly in difficult markets, every 1% counts.
Yeah, okay, thanks.
And I guess, to summarize, if I were really, really concerned about that, I don't think I would show them in the search. I would just sort of say, let's go with an index. But I think that active managers tend to be a little bit quicker and sometimes more flexible in rotating in and out of sectors that might be going in and out of favor.
Natalka, this is Charlie. Looking at the middle column where you've got the investment by property type, DFA has considerably more in cell tower than the others, well, than one, but it seems good. And yet, well, that would seem to be a good thing for me in terms of the uncertainty going forward with office even and the others. And I don't know, that kind of stands out to me as a positive rather than a negative, but, and their expense ratios are good, but comment on that, please.
No, you're good points, because they're not overweight retail when you look at some of the other breakouts. So in some ways, I don't know, Charlie, if your point is that results should be even stronger than they are.
Well, maybe going forward.
Pardon me?
Maybe going forward thinking that way. I don't know.
Yeah, no, I think that going forward, they have very good exposure both to the cell tower, and they also have good exposure in data center. So I think that I like it on a go-forward basis.
I guess my just off-the-cuff thought about this whole thing is that everything I've read about this unprecedented time that we're living in is that things are going to change significantly. Mm-hmm. After every pandemic, when you look through history, things change big. So my inclination, therefore, would be to go for a more active manager than a passive one, simply because of the fact that if change is going to be, I don't expect I'll ever go back to an office again. It just, our company, we've got 50,000 employees across the globe, and they've said, everybody working from home, we're not really noticing any difference in how things are getting done. So why in the world are we going to make everybody go back to the office? If people like working from home, and they do, then we'll just let them. And so I think those kinds of conversations are going to occur across the globe, obviously. Mm-hmm. And so anyway, that's just my personal opinion, that I think we should tend to, I would prefer a active versus passive. And given that their returns are all right there in the same ballpark, I don't know that really could make a, historically looking back, can we make a mistake? But given that everything's so upended right now, I think it would be better to be active. That's just me.
I have a question for her.
Okay.
Yeah, this is Earl Hall. I'd like to look at that alpha number, because that talks about real return on a risk-adjusted basis. Could you go over that for everyone and kind of look at the differences of those?
Sure. No, very good points. And, just to sort of let everybody know, on page 10, we do include a bit of a glossary of terms, and alpha is one of the things that is defined there. So even sort of, after my explanation, you might want to refer to that. But as Earl mentioned, alpha is a measure of risk-adjusted return. And the alpha statistic features return versus the beta, or the market risk of the market. And so the higher the alpha, the better, because if you have a high alpha, your numerator, which is return, is either really large, or your denominator, which is the risk factor, is smaller. So, and this is a 7-year alpha. With most risk statistics, you like as many observations as possible to make it as statistically significant as possible. And we had a long enough track record for all of these funds to do a 7-year alpha. So again, the higher number is the better number. And index funds tend to have a pretty low alpha because well, they're the index, and there generally isn't much performance above the index. The reason the Vanguard Real Estate Index Fund even has an alpha of over 1, many times it's lower than 1, is because the index is not as tight a fit. They've made that change now, so their alpha may go down. You know, the active managers here, the more active managers certainly have the more attractive alphas, not surprising. And the same holds true for information ratio. That's another risk-adjusted statistic, and it's based very much on the index, the volatility of the fund performance versus the specific target index. But there again, you want the higher the number, the better. Whereas things like standard deviation or beta, those you want the lower numbers. So going from both Earl's comments and Greg's comments about the marketplace and maybe favoring active managers to be more responsive, and certainly the risk-adjusted returns favor or support that historically active managers have been quite nimble and have the ability to add value. You know, it's a close call between Cohen and Steers and Principal Real Estate Securities. And I think that if you want to tie in fees and you don't want to go totally index, like with a Vanguard, DFA sort of straddles that fence a bit. They're active, but they're quantitative. And that's reflected even in their alpha number and their information ratio number. They tend to compete with the active funds with those statistics quite well.
Here's the thing that concerns me about the 7-year alpha and the turnover ratio for Cohen and Shears is they've pretty much had a tailwind going with them over the past 7 years with the reduction in the cap rates we experienced in commercial real estate. And I'm wondering if we will see the same alpha projecting forward if they have a headwind now, and that is cap rates increasing in commercial real estate.
You know, a good point, a concern. It's difficult to you know, try to anticipate how that might work out. I can only, you know, sort of say, and we can provide, if it's helpful to you, we only have annual returns in the top table that go back to 2011, just because of space. Obviously, we have in our databases annual returns that go back further than that to see how they've, you know, weathered on an annual basis over, you know, they have the longest history since 1991. I know that they generally tend to be pretty strong players year in and year out, but
we're looking back over a bull market.
Right.
And now we're in a recession. I would be curious to see how these funds did from 2005 to 2010, kind of capture a recessionary period.
okay, and we can run that analysis. We can sort of run that period actually even specifically.
They've got a unique mix, Cohen Steers. If you look at them, they're the least office.
Yeah.
And they're heavily into the infrastructure data, which I think are
That's only going to get bigger, I think.
positive things too. I mean, they seem well positioned right now.
I would say going forward, a small allocation to office and more to your data centers, because I think
Yeah,
that's...
I mean, that looks to me like a very positive for them going forward.
Could I ask another question?
Sure.
Earl Hall again, I have a question going forward also a little, and this might be very impossible to answer, but we have a government who has now pumped trillions and looks to pump a few more trillion into the economy. Are you people thinking at all about 2 years from now, because our good Fed chairman said we'll keep interest rates at zero? So what happens when all of that money comes due, basically out there running around looking for something to buy? Would not inflation begin to go up a little bit, and whatever real estate we had ought to do pretty well in that kind of time frame?
Well, we definitely agree that there's, it's one of the things that has us scratching our heads, how this is, all going to unwind or end. There's so much focus right now on just getting us through this downturn, and there's a lot less concern at this point in time about how we then recover from the recovery. And and certainly at this point in time, I think that a case can be made that buying into real estate, whether it's direct or through REITs, you're getting to buy in low. And I think that you as a committee are focusing on the right thing and sort of saying, well, looking forward, what are the property types and sectors that might do the best? I think that people are still going to need places to live. I think that, residential will, come back, and maybe in different formats. I think that senior living facilities, the demographics say we still need them. We just have to figure out a way for them to be safe. But, they're going through a difficult time now, but that may change in the next couple of years. And yes, I think a lot of these things could be inflationary. And it is one of the Fed's mandates to try to also contain inflation. So the Fed has, reassured the markets that, they're not going to run out of money. They're not going to stop the printing presses until the economy is back on its feet. Their next challenge will be then, sort of unwinding and hoping that we don't go into a taper tantrum, and potentially controlling inflation. As you said, it's a very difficult and multi-part question to answer. A lot of things come into play, but I do think that real estate will be an asset class in the next 3 to 5 years that, while it will change, will participate and be a good place to invest. One of the other reasons I failed to mention that we're focusing in on REITs, public real estate, at this point in time versus direct real estate, and Earl's comment reminded me of it, is just that many direct real estate partnerships now, they have, they value a private real estate or direct real estate investment is valued through the appraisal process. So the direct real estate results through the first quarter didn't look bad because they were operating on last year's valuations and last year's rental payment history. In March and by June, most of those partnerships that are open currently, they've already thrown up gates for exiting the fund. So liquidity in direct real estate, when times get tough, to protect existing shareholders and to have money to invest in, potentially distressed deals that may get better, they throw up gates and you can't get your money out. And so right now we would just prefer for Murfreesboro to be in a lower cost, liquid, no lockup segment of the real estate investment market, and one that also invests in the property types that have a real strong possibility of doing well.
Yeah. It's Scott, right? So do we want, I think Scott's suggestion about looking back at the recession, it has merit, just to give us another data point. So if we ask Natalka to do that and we come back next month, do you think we would be in a position to make a real decision on this, or do you want to charge ahead now?
I think it would be interesting to see how well the real estate held up, how well each one of these funds held up through the recession. But for the active managed funds, I think it would be good to also see how they have managed their portfolio and how their allocations have changed over maybe the past 5 years. Back to Charlie's point, if Cohen and Steers, through their active management, if they are changing their allocation away from office and retail more towards infrastructure and data centers, that may be the people that we want to, because they are actively managing it towards what we're talking about.
Yeah.
And if we could see the transition.
It's going to be easier, getting out right now in some of these office and retail deals might prove difficult.
Yes.
Which,
And it's easy to manage when you got a tailwind. It's hard to manage when you got someone, with recessionary pressure in front of them.
Okay, I will put together those data points for you and get them down to you for next month so that you have them to review. You might want to, as a committee, while you're together, think about or, have some discussions as to who you are favoring, or I don't know if you feel like you're in a position to narrow it down a little bit, but that might be helpful. But yes, I think that viewing this through, the 2005 to 10 period would be interesting and provide some insights that perhaps this doesn't do. I mean, really the only recessionary point that you have is first quarter of this year.
Yeah.
Right.
Yeah.
So I will do that. There was one last thing that I wanted to mention. If there are no other questions on the REITs, I don't want to shut down the conference, the conversation on that if there are still additional questions or requests of us.
I don't think so. It sounds like we're steering towards Cohen. They had the higher alpha number too, as Earl was pointing towards earlier. And then the way they're distributing their investments sounds like what we're looking for. I think that past history through the recession in 2005 through 10, how they bounce back from that will be interesting. So you go ahead, unless there's any other questions, which I'm not seeing any.
And Okay, the last thing I wanted to mention, because I don't know that we're providing you with enough reading material and enough ideas, but not surprisingly, I mentioned how with the Fed backstopping bond credit markets, both investment grade as well as high yield, many bond managers are coming up with what I'm going to call special situation credit bond funds. So in essence, they're going to, they're anticipating, they're structuring it like a private debt fund where they'll have a 2-year lockup and then expect, to pay out the fund. But they're raising small partnerships to address, what they consider to be unique opportunities in both high yield, investment grade credit, asset-backed, non-agency mortgages. It's basically a go anywhere, do anything bond fund. No leverage employed though, so it's not what I would call unconstrained. Unconstrained bond funds in the past had leverage. This is a no leverage situation. But we're going to put together, if you will, sort of an explanation piece and identify some opportunities that we think are interesting, and it might be a good diversification within your fixed income exposure. So it'll be something for your consideration, and we'll send that along as well, and it can be a conversation that we can have in the next month or so, or month or two.
Natalka, this is Charlie. One quick question. What size investment are we contemplating if we move dollars into one of these funds?
Oh, into the REIT fund?
Yes.
Yes, good question, and I should have addressed that during my comment.
It's probably in our material, but I didn't catch it.
It's not really, but over the past 12 months, we have been increasing and overweighting the plan's exposure to your global REIT fund. Once the committee approved the expansion of the allocation from 7% to 17%, because you didn't have a direct or a public real estate option, we were using the global REIT fund as a surrogate, if you will, and your current exposure in global REITs is up to about 13%. That worked very, very well for you in 2019. It hurt you a bit in the first quarter, but no more so than if you had been invested in both a U.S. REIT and a global REIT fund. So the first thing we would do is probably take some of that allocation out of the global REIT fund to put into the dedicated U.S. REIT fund. So initially I would start off with a target for U.S. REITs that would be in the 5 to 6% range, and maybe initially fund it at the 3% level, and then, dollar cost average in, and, maybe over the next 3 or 4 months up to the 5 or 6% level.
Okay, so 7 million-ish, something like that, when we get to the point. Okay.
Yes. I mean, we still might want to leave some money available in that 17% allocation once, things begin to shake out more in the direct real estate marketplace. But I think that right now I just favor keeping things liquid, not necessarily having a long lockup, and focusing on the sectors that we think might do really well going forward. And to me, that all points currently at U.S. REIT funds. Now, there's no doubt that also in the private real estate market, much like in the private credit market, that people are putting together deals that are focusing in on either distressed properties or distressed property types and there might be opportunities, but there, you know, we'll see what comes along in that regard.
Thank you.
Okay.
This has been good.
Any more questions? It looks like our next meeting would be July 15th if we meet in a month. Does anybody know if that works well with their calendars yet? Haven't, okay, all right. That's probably what we'll shoot for, Natalka. And we look forward to what you send us back for our consideration on this.
Okay. Thank you so much for your time. Maybe July 15th, if you'd like for me to come down in person, if that sort of works, that'd be great. And if not, we'll continue social distancing.
Very good, thanks.
Who knows what a month will bring?
I know, exactly.
Any other questions or comments from the commission before we adjourn? No? Then we stand adjourned.